Tonight, Beijing fired a quiet but devastating shot in the chip war. An internal directive to major buyers: stop leaning on US silicon. Call it guidance, call it pressure, call it the ban that isn't on paper. The effect is the same. Procurement chiefs froze. Cloud planners paused. Traders reached for the sell button. And in Washington, critics say Trump world allies and hedge heavyweight Scott Bessent signaled pragmatism. Opponents call it a blink. Allies call it a bridge to keep supply flowing. Either way, the optics are brutal. This isn't a cartoonish total embargo yet. It's targeted where it hurts. State-linked stacks, hyperscale rollouts, and AI builds that live or die on accelerator deliveries. Think Nvidia H20, China bin SKUs and fragile revenue deals, suddenly under a cold light. So, is this leverage or capitulation? Did Beijing call Washington's bluff? Or did Wall Street script the play? Beijing didn't issue a splashy law. It issued something sharper. Internal guidance that lands like a memo and behaves like a mandate. Procurement heads at state-linked firms were told to avoid US accelerators and pivot procurement plans. Cloud budgets hit pause. Distributors asked for clarification. That word means delay. Vendors read the room. If your rack plan depended on US SKUs, even the downgraded, China-only versions, you're suddenly revisiting bill of materials, power envelopes, and delivery windows. Every slipped quarter is a lost training cycle. The guidance targets where dependency is tightest: hyperscale AI buildouts, research labs, and government workloads. It nudges buyers toward domestic stacks, Huawei accelerators, local NICs, and homegrown software, while starving momentum for US silicon and projects. On the US side, the stop and think effect ripples fast. Licensed China bins were supposed to thread the needle, keep some revenue flowing while honoring export controls. Now even that middle lane looks risky. Markets notice choreography. Local champions rally on import substitution. US chip makers face headline risk, guidance revisions, and longer sales cycles. Equipment suppliers feel second-order squeeze. Bottom line, it's not a blanket ban. It's a coordinated slowdown that changes behavior today and pricing power tomorrow. Here's the compromise Washington's money crowd tried to sell: keep the most advanced AI chips off limits, but let degraded China-only SKUs flow under a tightly policed license. In return, a mid-teens revenue skim on each approved sale, compliance audits, and the ever-present threat of clawbacks if anyone color outside the lines. On paper, it looked clever. US firms retain a slice of the world's biggest AI market. Beijing gets workable performance. Not cutting edge, but enough to keep clouds online and research pipelines moving. Wall Street likes continuity. Regulators like a knob they can turn. Enter politics. Critics branded it pay-to-play. Supporters called it harm reduction. Starve China of top-shelf silicon while preventing a total decoupling shock that boomerangs into US earnings, jobs, and R&D budgets. Then Beijing's guidance hit. The middle lane suddenly narrowed. If state-linked buyers won't touch US accelerators, downgraded or not, the licensing math breaks. Sales forecasts slip. That neat revenue share becomes a rounding error. And the optics? Rough. It looks like Washington offered a bridge just as Beijing lifted the road. So the question isn't whether the deal was legal. It's whether it was viable, and whether Beijing just proved it wasn't. Nvidia's H20 was the compromise: performance turned down, export paperwork turned up. Beijing's reply isn't a press conference. It's procurement language and hallway meeting. Tenders start adding localization preference, security provenance, and resilience scoring. Translation: if you pick US silicon, expect questions. If you pick Huawei Ascend, expect a fast lane. Priority import slots, power guarantees, maybe tax perks and cloud credits. Quiet pressure beats loud bans. Technically, H20 still wins in some raw metrics. But ecosystems win wars. Huawei pushes Ascend Con Mindspore with bridges for PyTorch. Tooling matures, model repos get ported. Universities and state labs get grants that assume domestic accelerators. CAPEX follows incentives. There's also the label game. Projects reclassified as pilot, internal R&D, or sensitive workloads. to keep them off US parts. Compliance officers don't argue, they hedge. CFOs rerun risk scenarios. Sanctions tail risk. RMA logistics. License renewals. Suddenly a slightly slower domestic stack looks cheaper than a headline. And yes, performance per watt matters. But availability per quarter matters more. If Ascend clusters arrive on time with guaranteed scale-out, the pipeline moves. If H20 ships into bureaucratic fog, roadmaps slip. This isn't a knockout. It's tempo control. Freeze the US pipeline. Feed the home ecosystem. And let inertia do the rest. Screens told the story first. Green in Shanghai. Red in Santa Clara. Domestic champions caught a bid. Foundry adjacents. Server integrators tied to Huawei. And anything labeled import substitution. Flows chased policy, not perfection. If procurement tilts local, earnings momentum tilts with it. Across the Pacific, US chipmakers felt the headline risk premium widen. Distributors talk pushouts. CFOs float prudence on China exposure. Guidance gets language like uncertainty, visibility, and scenario planning. Traders hear multiple compression. Second-order pain shows up fast. Tool makers with outsized China revenue face uncomfortable questions on order books. EDA and packaging names get dragged on read-through. Options markets price fatter tails. Put skew steepens in the big semiconductor ETFs. This isn't panic. It's hedging. Meanwhile, factor rotations flicker. Out go high beta AI exporters. Income domestic China AI stacks. Power gear memory names that can slot into local builds. And selectively rare earth and materials plays feeding that same story. If subsidies and fast-track approvals cluster, capital follows the calendar. Global allocators do what they always do in regime shifts. Trim overweights, shorten duration on the AI hardware trade, and pay up for availability over absolute performance. Valuation frameworks bend to policy math. Call it what it is, not a crash. And repricings don't end on day one. Chip wars don't start at the server rack. They start upstream where the tools are. If Chinese buyers sidestep US accelerators, data center build-outs slow, and with them the orders for lithography adjacents, deposition etch, metrology test, and packaging gear that feed those roadmaps. Tool install calendars slip. Field service engineers wait on visas and clarification. Spare parts kits sit in bonded warehouses, while lawyers debate license scope. Vendors feel it in two waves. First, the pause. Purchase orders pushed a quarter, acceptance testing rescheduled. Then the mix shift. Demand pulls toward domestic tool chains. Refurbished lines or good enough nodes that can scale without headlines. Even consumables, chemicals, resists probes take a hit when qualification cycles stall. Finance teams do the math. Lower turns, less absorption, softer gross margin. Sales swaps pipeline for contingent. The message to investors: visibility narrowed. Risk widened. Policy was aimed at chips. Collateral landed on the factory floor. Beijing doesn't just push memos. It moves money. Policy banks, provincial funds, and little giants programs funnel capital toward domestic AI stacks. Accelerators, NICs, memory, power gear. So a procurement becomes industrial policy with a purchase order number. If you build local, you get terms, cheap land, tax holidays, grid priority, trade rebalances with teeth. China leans on choke points it already dominates. Rare earth refining, battery precursors, magnet alloys, and those headline metals gallium and germanium. One customs tweak and global lead time stretch. Do they weaponize everything? No. They signal enough friction to price and risk, not a full cutoff. On the US side, tariffs and licensing knobs stay ready. But knobs can't print wafers. If the middle lane closes, expect more waivers that aren't and carve-outs that expire. Policy gray zones to keep legacy nodes and supply chains alive. Bottom line, capital and commodities decide tempo. Chips are the headline. Inputs and incentives are the steering wheel. Whoever owns those owns the next quarter. Tariffs are headlines. Cash flow is discipline. If Beijing's guidance sticks, US vendors lose velocity and discount harder to hold share. Margins thin, R&D gets triaged. On the other side, China pays a performance tax. More racks for the same compute, more power, more engineers. That's money too. Bankruptcies, not the giants. The middle distributors. White box integrators. Second-tier tool suppliers caught between delayed POs and fixed debt. Policy levers won't change physics. They shift timelines. Stretch enough quarters and the weaker cap tables crack first. Who blinks? The side that runs out of runway, cash, wafers, or political patience before the other does. That's the real scoreboard. Here's the twist. Nobody won. Beijing traded peak performance for control. Washington kept rules, lost momentum. Markets hate both. Takeaways: guidance beats bans. Behavior changes without headlines. Availability outranks benchmarks. Racks that arrive on time win deal. Middle lane licensing works until politics rewrites the map. What to watch: procurement language in tenders, data center capex mix, and any carve-outs that magically appear before quarter end. If local stacks scale, the pricing power shifts with them. If delays pile up, both sides bleed time and cash. Your move. Tell me who blinked, why, then hit subscribe. This play isn't over yet.